Good evening again. Today in our traders group we are going to discuss a strategy which based on volatility, and as you can see on your screen, it is very interesting topic and it has an H. You can see this double H letters. It is hard to read, and I did deliberately use these fonts to show the complexity and as well lucrative approach to the trading strategy. So before we start, I have to do a disclosure, as we normally do, that presented material is for educational purpose only and should not be constructed as personal financial advice. Futures and futures options trading involves risk. Past results are not necessarily indicate of future performance. Options 21 provides educational support. We as well exclusive software provider for OptionView, and we've got Australian financial license. Next would be disclosure related to OptionView, because they constructed this strategy, and this strategy, of course, in this case, for educational purpose only, and you have to take precautions how you can implement this, because investment outcome are hypothetical in natures and, of course, not guaranteed. And all damages are excluded because it's public speaking, and you have disclaimer in front of you. If you have any questions, please let me know, or you can address me via email. I'll start from the history about this specific strategy. This strategy was embedded into OptionView and developed further by Len Yates. Len Yates is president and founder of OptionVue Systems International. He has been a chief programmer of OptionVue Systems since its establishment, and he is continuing to develop system. What is remarkable that in early 2012, he read the article, which was very stunning to learn, and that article addressed the outcome of the VXX. There was there was a strategy described by Larry Macmillan, who reported this in his article, and he said that his return was five times on investment money. So Len Yates invested his money as well, and you can see that he has amazing results. Less than 2 years, he was able to achieve 4.5 times return on his capital, from 42,000 to 185,000. And what is amazing, that he didn't take much leverage, because this instrument today, which we'll discuss, they are not options, they are not futures. However, they are derivatives, and I'll explain you why it is different. So you can see the graphs. People who actually follow the strategy very thoroughly, they've got 238% since April 2012. And this is very steady. Of course, it's not just a straight line, and you can see that there was, you can see that in some point they're losing money, and but ultimately it is exceptional performance. And we will talk how this strategy constructed, what has been used as a basis for the strategy, and what you can do about this strategy for yourself. The graph here showing VIX. Some journalists, some people call VIX as horror indices, because in reality, VIX is representing concerns. You can clearly see on this picture that some spike, just recent spike in 2013, over here, here, and even here, were related to some US problem, whether it was some problem related to potential default of United States or some budget battling. But every time when political situation and economic environment is uncertain, people try to protect themselves. And more importantly, big hedge funds, what they do, they buy lots of puts and they protect themselves through different derivatives. And therefore, the cost of hedging, the cost of insurance is going up very, very rapidly. But then when it's resolved, it's plummeting back, and that's the nature of volatility. So that's the volatility itself. It's a pure representation of volatility because it's presented by index VIX. So we not talk about how it is constructed in terms of VIX because it's rather challenging mathematic method to accumulate all data from S&P 500, but you need to know that basis for the strategy is VIX. And on top of this VIX, there are futures. So you cannot trade indices itself. You can only trade derivatives from the indices, whether it will be futures or it will be different products. And in this case, volatility products represented by VXX, which is exchange traded note, SVXY, which is exchange traded fund, and mirror or inverse positions, XIV, which is exchange traded note, VIXY, exchange traded fund. For many of you, these terms, exchange traded note and exchange traded funds, are familiar, but if not, don't be frustrated. We will come back to that and I'll explain you what's the difference. What is most important here, you need to understand this is very complex nature from defining the risk and then projecting this risk using futures and then working through these futures via volatility products. It is kind of quasi-system, if not more. But what we can observe that these volatility products having very interesting correlationship. For instance, if ETN, VXX is going up 2.3%, then its peer exchange traded fund goes exactly the same percent. However, inverse is correct. You can see XIV, exchange traded note, goes opposite way, 2.3, and its peer VIXY ETF goes 2.3% as well. It's important to understand because this negative correlation can be used in your strategy. And again, this is not options. This is exchange traded notes and exchange traded fund. Again, history of VIX showing that there was a significant drawback. You can see that early 2009, straight after crisis, when everyone was still shocked, the premium to buy puts were very, very expensive. And therefore, it was reflected in 7,000 for contracts. But then gradually, fears disappears. And then you can see there was another 2010 summer, and then 2011 as well summer. And then it's gradually become very, very low. From 7,000 to a benchmark of 12, that's a great movement, of course. And you can consider that, of course, volatility has diminished. But there are other factors which defined the such a dramatic change in the price of VXX. And one of them is rolling yield. I'll explain you in a few seconds. So just important to see how our environment changed in terms of volatility and perception. On the other hand, you can notice that this volume of trade of these contracts have increased. So the volume of the protection significantly higher than it was here. Okay, again, actual results are very dramatic as well, and it's just repetition. This is just how we construct VXX. It's not we are constructing VXX. VXX actually note which was developed by Barclays and it's still managed by Barclays. And I'll touch bases with Barclays later. But what is important to understand that ETN is fully invested note, which has 30-day duration. It's basically invested in two contracts. First contract is the close contract, which is, for instance, June, and second contract is July. Therefore, VXX investing in futures, VX futures, and they constantly having exposure which is equal to 30 days exposure. And of course, prices for first contract and second contract could be completely different, and it depends on the structure, term structure in financial terms. What is important to understand that every day manager of ETN has to do rollover. He has to sell this close contract and buy longer contract. So you can see that next day, for instance, Thursday, proportion is 50-50, and that's fair enough. Second day is different, 47 in first contract and 53 in the second contract. So remaining days, of course, of first contract less, and we are rolling over from first contract to another. And you can see there is inverse correlationship between SPX, which is ASX 500, and VXX. They are moving different way. This is quite important as well. And you can see as well that the rolling effect affecting the price of VXX. You can see that when volatility of SPX went down, when SPX went down, not volatility, but SPX went down and then came back, returned to its place in November, no problem. But in terms of VXX, we've got the difference, this gap. So all the prices came back. Volatility did not match this. Again, trading system is quite simple. OptionVue calculated its own indicator, which calls VXDIF, which stands for VX difference, the difference between price of the second future, VX future, and price of the nearby future, first future. And OptionVue uses 15-day moving average to smooth the movement, and so they can see the calculation based on 15-day moving average. This is a screenshot from OptionVue, and you can see there are few indices. One of them, of course, it's VXDIF, and you can see this 0.71. It could be positive or negative, and it has significant meaning because this helps you to determine which way it will go, and I'll tell you in detail how to define it. Of course, OptionVue calculates not only difference between two futures, but as well it calculates rolling effect, what happened between prices and what happened in terms of fair prices. So it does very detailed analysis of VIX itself, giving you prices, and it gives you very detailed preparation, like very detailed explanation what is going on in terms of term structure. Okay, so in early 2012, Len Yates developed this specific index, which is difference between futures. And what he observed that his system worked quite well. You can see that VXX went down, and his prediction, which is over here, because it's above zero, showing that you have to be short on VXX. You have to sell VXX, and it's all the way here, confirmed by this index, showing really good result. So you could be happy, but Len Yates decided to work further, and you can see that his work was continuing in 2012 and ended by the end of 2012. So you can see that he is using additional index, which is LVI, Len's Volatility Index. And you can see that if we are doing some examination, And we can see that even flash crash was predicted by this movement. So you can see volatility is going up and index tells you what to do. If volatility goes up and you are long VXX, that is very positive for you. But if you're short, then it's negative for you. So volatility goes down, and of course, your VXX is suffering. This index is showing you where to enter and where to exit. When you combine two indices, specifically the difference, Len volatility and Len's volatility, which is LVI, the results are even better. And I'll show you calculation in a few seconds, but you can see that before this flash crash, which happened here, over here, the indices already, with the bar going down, meaning that volatility is increasing, show you, and potentially you could take advantage. And if you were long in VXX from that point, then of course you'll be very sweet. Okay, and then the situation has changed over here, and of course volatility is going down, and the index itself showing that you have to be short because it's crossing 0 point, and volatility is decreasing. These bars goes up above 0. So combination of those two are giving you a very good, very precise point of entry and exit, at least in the past. Now you can see results which were made initially, and you can see that Len managed to increase 3.5 times his initial capital, and he was sometimes long, he was sometimes short in VIX because XIV is exchange traded, not represented short position, and then he was long and short and long and short. And this is again, you can see Len's volatility indicator, an indicator that shows whether volatility as measured by actual price movement in SPX is increasing, and it's below 0 as I show you, and when it's decreasing, that part above 0. And results even better. You can see from 1 it's actually improved to almost 80 times. 80 times your money in 3.5 times. And you've never been exposed much in terms of losing time value, in terms of options, or being really freaked out about your futures. So it is, of course, different style. And this style is more appropriate for investors rather than traders. You don't have to be in and out. You don't have to, again, being trading all the time and over traded, because index will give you a precise enter and you just follow the index, right? So what Len did, he finished his study in 2012 and he invited our clients to use this, and since then it has been still very good. And you can see that basically almost all this time volatility was falling down. Okay, so that's result. And again, let me remind you what is roll yield. Roll yield is positive when you are selling. Let me just start from normal rolling yield. I'm sorry, roll yield is the difference, of course, when you're buying and when you're selling. And there are different strategies, there are different theoretical platforms to explain that difference. For instance, if rolling yield is negative when you are selling this contract, which is in front $15.90, and then you have to buy $16.90 to keep up with holdings, 30 days holdings weighted within 30 days, right? Then, of course, you are losing. And that's one of the reasons why index is losing. And this is normal situation for many contracts. And this is in term structure called a contango, but you can call it normal term structure. and this is representation again. So the fund manager has to lose its yield when he is moving some of his holdings from short future to the short dated future to the longer dated future. That's important. Short dated future to a longer dated future. And at some point, he will have 30 days left over here, and he will be fully invested in this future, July future. However, there could be a situation when market conditions change and supply and demand suddenly change, whether it's equity or whether it's commodity. Suddenly closed contracts are very much in demand and price is higher. So it is 41.60, you can see it, 41.60, and you still have to roll them over and you still have to sell them and you have to buy a second contract. And in this case, for fund manager, of course, it is beneficial because he is selling high and buying low. And that's how he got the rolling yield. He's getting additional money. Okay. So again, first one is normal, and that's most of the cases when his negative yield occurs when he's selling low and buying high, and positive yield with backwardation structure when he's selling high and buying low. And that's, of course, reflects in price of VXX. In normal term structure, negative roll yield depressing the VXX price. And that reminds you the sharp movement down of VXX since 2009. Of course, it's not only because of the rolling yield, it is combination of factors. And in terms of backwardation, positive rolling yield helps VXX to reacquire its value. And there is a second factor, which is really, really important, is volatility. Whether volatility is rising, and then VXX is rising. And then if volatility is decreasing, then VXX falls. So two major factors affecting. Changing volatility level affecting immediately. It gives significant change, very sharp movement, down or up. And roll yield is very stable, slow, and it's yield, right? So it's more income-like. And you can see this is reflection of volatility to the SPX. Shares are going down, volatility goes down. Shares up, shares up, volatility goes down. It is normal relationship, and normally, as Paul taught you, it is important to remember if volatility goes up, then prices going down, and vice versa. However, there are a few exceptions with futures, which is not topic of today's presentation. However, we need to warn you that VXX and XIV, which is an inverse position of VXX, are volatile. And of course, you need to take on consideration your own risk and see whether it is acceptable for you or not. We've got an example of our clients, of OptionView client, who just bought inverse VXX at 10.7, and then suddenly prices dropped to 8.1 just in 5 weeks. It could be even more substantial movement because volatility is sometimes very much substantial. And even that, Len Yates found it that using stop losses in this specific cases probably not the best. And this is related to the nature of this derivative, VXX, because it's not option, okay? Another warning, you need to consider that there is a daily adjustment factor. Of course, you can be most of the time on the short side of the volatility, and then rolling yield will not affect you because if you're on longer run, of course, you will lose because most of the time there is normal structure and effectively there is a decrease, slow decrease in prices of VXX. But you can be on short side, but if you are on short side with inverse products such as VXX, then you have that very unpleasant daily adjustment factor. What it means that daily movement when futures goes up and then return to the same level, right? Then in reality, they are not really coming to the same level. They are actually a little bit less, 2.91. So there is a drop, and of course you are losing that through the day. However, you can be very aggressive with your approach, and there is a question how aggressive you would like to be. We are very much realistic, and we understand that volatility could be a threat for your account. Therefore, if you are into that strategy, very prudent way would be to segregate your funds for that purpose. But that's extremely conservative, okay? That means that nothing else will be affected by your strategy trading volatility, okay, if you do that. And that's actually a good approach for some risky strategies, and that's just representation of risky strategies. However, it is not most riskiest strategy I know. When you decided if you trade, then you need to dedicate yourself and you obey your decision. And then you can utilize your full cash, you can utilize fully cash in this segregated account, invest fully into volatility, or you can have 50%, you can be in and out, managing your risk accordingly to market sentiment and news and technical analysis. Next question will be whether you're going to use margin, because of course margin is substantial threat if it goes against you. It helps you when it goes with you, but it hurts you even more when against you. So margin is a big question because you can lose more than you have on account. Second question is whether you use options, because VXX is derivative itself, but you can do derivative of VXX instead of buying, say, XIV, which is inverse VXX, you can buy puts, right? And then if you buy put, then effectively you are shorting your VXX. We will discuss 3 drawbacks to the shorting of VXX. First of all, if you are shorting position, specifically selling short VXX, meaning that you borrow VXX from someone and then sell it, then effectively you might see situation that you need to sell more because it goes that way. You need to sell more. And then after you sold more, market could move completely against you and that it could trigger a margin call. That would be really unpleasant. But what would be absolutely not acceptable, that you can lose in your capital more than you actually have on your account. And that's nature of margin. We talked today about margin with one of our clients. And when you're selecting margin, you have to be really thoughtful because you're putting your assets against this margin. It's not only on your account, but it's as well your other assets. And you have to be really prudent about it. Okay, so what you can do, 3 ways of managing your position with VXX. You can just simply long XIV, and it means that you are having just a note, exchange-traded note, and whatever happened with this bloody futures, you will be not affected, because unless something happened with note itself, you don't have to roll it over. You don't have to think about managing your position. That's very simple. Or you can short VXX, as we discussed. Or third, you can buy deep in the money VXX put. Why it is deep in the money? Because first of all, your time decay will be less explicit. It will be less affecting you if it is deep in the money, because time value will be less in time. And as well, second point, your VXX put, as deeper as they are in the money, the less risky you are, because in fact you have less leverage. If you are out of the money, then probability being in the money is less, and therefore you are leveraging on it. However, by utilizing puts, you can save in terms of your exposure. What you could do, you have 12,000, for instance, and you can use 1/3 of it, 4,000, just to buy puts, and then you will see that you've got the same delta, the same exposure as you would have ETN XIV. So that's another strategy. Of course, it's more riskier, but you still will have this money on your cash, and whatever happened with your puts, you won't lose them, but you will lose 1/3. Right, what could wrong as well? Of course, anything could affect market really badly, and really, catastrophic reality could happen suddenly, and then you need to manage your position really quickly, because first of all, if you are, for instance, long and with VXX moving up, then it's good. But if you are short VXX and you are long with its XIV, which is completely inverse, then you have to close your position. And maybe this position could be with a loss. Okay, now let me just describe this volatility product. First of all, VXX. It is exchange-traded note developed by Barclays. And XIV, it's a Credit Suisse note. And these two are exchange-traded funds, and they are managed by ProShares. So what's the difference between exchange-traded note and exchange-traded funds? There are some text difference, but I think we should not discuss it, because that's as well related to US citizens, and it could be a different implication for Australian citizens. But what is important? By using this strategy, of course, you will be removed by 8 steps. And to be honest, any trading of derivatives is the example of such removement to a more or less degree. You can see, first of all, that company could be absolutely not transparent, and you may have no knowledge about what is going on, whether the accounting is cooked, whether they have a reliable source of income, whether they develop themselves. Second is the legal risk, how you own your shares, whether it's under your name, whether it's under your broker name. There are many questions and many risks, but it's very remote from you. And of course, when you try to manage your portfolio, you would like to know as much as you can about company and about legal issues, and how these shares actually represent fair value, whether there was split or was reverse split, and how it has affected the fair value of the company and assets. But then all this information is aggregated from many stocks within S&P 500 into one index, specifically an option index, put option index, basically, which converted to VXX, okay, which is aggregating the cost of insurance of these companies to have. And then based on this VXX, we've got traders, or we've got banks, institutional clients, who are actually creating these trades of the VIX. They see and they expect that volatility will go down or down. They're supposed to trade futures, and then based on these futures, we create this volatility products, which is already using VXX, again, derivative on derivative. And then if you want to use options, of course, you create your own view on that derivative. So that's quite a shaky ground, to be honest, but people somehow understand where market moves, and they make their assumptions. And one of the reasons why Len Yates does not recommend to buy options on VXX, because his perception, it is a way too remote from reality. But that's your choice. Again, VXX and XIV are exchange-traded notes. And what is exchange-traded notes? It's a promissory note issued by the bank, in this case, Barclays Bank. And I said that what might happen with Barclays Bank, we don't know. I mean, it's a huge bank, but we know some cases, horrible cases, when bank went under, and of course, we don't know whether it could be the fate of any other banks. So promissory notes are getting return, whether it's positive yield or negative yield, whether volatility goes down or up. They are trading on their proprietary accounts, and they're moving these futures, VX futures. We don't know whether actually they do trade. They can create just records, book records of the value, and that would be a reflection of exchange traded note value. I think they do trade. I'm not totally concerned that they don't trade at all, but I don't know how many of them they trade, and they just support the market basically. Volatility con is the explanation of two different approaches. Specifically is backwardation theory and contango theory, which is normal, right? So again, it's related to time and volatility, and again, if prices of the close to first, if prices of first contract is higher, say 7, and the price of and the price of the second is 6, then it is backwardation, because futures today is more expensive than futures tomorrow, and that will affect the whole structure, or opposite. And based on this, we've got different volatility approach. What is important to understand with the strategy, that results we're observing here already being tested, but there is a change in terms of the expected rate of return, because any strategy which works for some time and exposed to the public, of course, less efficient after some time. You can see that for the first 3.5 years, it was roughly 4 times each year, and it was up to 8 times for the period return on investment capital. But of course, more traders came and used this strategy, then efficiency dropped to half, and roughly two times each year. And we would expect that this strategy will continue to slide down in terms of return. Still, return is quite amazing. And as well, what we need to do, we need to understand that there is a certain level which has been established since 2012, I think, and 2013 is confirming it is approximately 12. That's approximately 12 in this scale. When there is a mean reverse in terms of volatility is coming, and then even it goes up, volatility goes up, then it's coming back to this mean of the volatility, and there is kind of pattern. Potentially, this average price could move somehow higher or lower, depends on market circumstances and sentiment. But you can see that it's quite level of support, I would say, in terms of 12. So it's coming back to 12 all the time. And VXX is growing up because, of course, 2 factors, volatility and as well positive yield. It's coming up. Right, now about trading tools. I mentioned that software, OptionVue software available for our clients, and it is as a separate model. You need to buy this separate model, and what you'll get this mathematical calculation of the difference between 2 nearest terms. And of course, if nearest terms is positive, then it is contango. It's a normal structure, and then we expect that futures tomorrow will be more expensive, and there will be a negative yield, rolling yield, and therefore we kind of expect where volatility could move. And opposite, if it's negative, then it's backwardation, and we can expect that volatility could drop as well. So we've got as well some forward prices, which giving you additional scope of analysis of 30 days futures, it's a little bit more detailed. And of course, this indices and fair prices for future value of this derivatives, more for the traders, for people who wants to trade actively VXX or XIV, and they would like to be in and out, in and out, in and out. And it is still good indicator for traders because they can see whether they still keep this position or they should think about closing position. But again, this is long position in any case, even short by nature. If you trade XIV, shorting volatility down, you're still long in this ETN. And you can sit there, and even it's a rough ride, you can still sit there if it's long term for you, okay? And of course, you can see some explanation of Darling rolling effect, so you can see how it is affecting your position. And of course, Len's volatility indicator helps you to define precisely points of interest and exit. Right, you can find more information on this website, OptionView.com, and then if you search for VXX, then it should work for you. And you can order this model through us, myself and Paul. And if you decided to go through, I will as well give you more attention, and I can send you a few examples of latest latest analytics from Len Yates, because he does send it every month, and it helps to understand